Good morning. It's Wednesday, the 12th of February, and this is Govindraj Ethiraj, headquartered and broadcasting usually in Mumbai, but now in transit. The take. In a few months, Mumbai city will see the commissioning of a new and second city airport in Navi Mumbai. Two airports in a city or in close proximity in a state in India are rare. Goa is one example. The other is, of course, Delhi, which has two, including Hindon and soon to be in Jewar in Uttar Pradesh, but close to Noida. The Navi Mumbai airport has been conceptually in the work for decades, but as things usually go with large infrastructure projects in the country, it's only now nearing completion. There is an ownership change too from the GVK Reddy Group to the Adanis, which may or may not have speeded up progress in the last lap. We are told that to start with, the no-frills carriers will shift from Mumbai's Terminal 1 in Santa Cruz to this new Navi Mumbai airport. Now, this was all the good news. In April, when the airport promises to start operations, most of Mumbai's residents will have to allow anywhere between 3 to 4 hours of cardiologically stressful conditions just to reach the airport. Allowing for another 2 hours before arrival, or maybe even more, you could have spent half the day or more just reaching the departure point. You might as well start driving, but then once again, it depends in which direction you're going, because Mumbai is designed to discourage you from leaving, particularly if you're northbound, or inflict such damage on your mental and physical faculties that you will choose to stay put. Now, the road that leads to the airport on one end, the majestic Atal Setu bridge, sails over the sea, but is not really connected to the western part of the city, at least properly, rather only the eastern part. And needless to add, the eastern and western parts of Mumbai are like two worlds apart and have been for decades or maybe even centuries, who knows. A promised 4.5-kilometer bridge that connects the west and east and to a new coastal road and westerly sea link quite literally lies abandoned. Building this important connector was never going to be simple. After much to and fro, we are now told that work on this critical component, a segment of this connector that crosses the north-south railway lines in central Mumbai, will start now. Now, this is literally years after the columns comprising the rest of the bridge have already been erected. But then, the project was conceptualized in 2013 to connect east and west and send traffic from and to the Trans-Harbour Link, now called Atal Setu. Not surprisingly, it stalled. It was revived again in 2016 and stalled again, and then revived in 2021 and then evidently stalled again, for which now an existing 100-year-old bridge will be dismantled, or what is known as the Elphinstone Road Bridge. Blame for these delays have been liberally passed around, including on right-of-way and buildings obstructing the path, which must be true. And yet work started on the columns leading up to this connector across the railway line, because presumably it is good form to construct where you can and when you can and think about the rest later. Mumbai is of course littered with such half-done bridges, and some of them are in close proximity too. From all prior experience, this bridge could take anywhere between the 12 months that has been promised, according to officials quoted in the print, or 2 years, or 5 years, or 6 years. Usually, expressways get constructed quicker in India today. A 1,000-kilometer stretch is delivered faster than a 100-meter bridge in Mumbai, or 3 years versus 6 years. A reading of local news tells us that the local municipal corporation and the railways who control the railway lines and territory around it are not usually seeing eye to eye. We're also told that when it's a double-engine government, that is, when the same political party runs both the centre and the state, things should move faster. But evidently that's not the case in the state of Maharashtra, where the problem, if any, is too many engines trying to drive a single train. Mumbai has a shiny new coastal road which does miracles for those commuting from North Mumbai to South Mumbai, the few who still do that stretch. What would have taken perhaps 45 minutes to an hour from Bandra to Marine Drive, or the other way around, is now wrapped up in 10 to 12 minutes. The only hitch is that the axis of the city has shifted several times in these intervening years. One new point in this shifting axis lies in the Bandra-Kurla complex, or BKC, which is increasingly becoming difficult to navigate to and within. Most people who work there tell me that they want to run from there. But where will they go? Parts of central Mumbai, including Worli, are looking promising once again. A metro rail through South Mumbai, which has already taken 8 years against a promised 3 to 4 to build, might shift things around again. Mumbai lives on and off its dreams of better infrastructure and a better life, which is always beyond reach for almost everyone. Mumbai also survives in shocking contradictions: a smooth coastal road on one end and potholed and uneven roads leading to it, bad enough to keep the country's orthopedic surgeons busy for a lifetime, or maybe good enough. Those who work in the richest civic body in the country evidently do not notice or even feel the poorly laid and relaid roads with all their uneven bumps, including at traffic signals slowing down traffic further. Back to the airport. It is an unfair strain on the users of the airport if they have to spend half their lives reaching the airport and back from it. But in another insight into the actual lack of any double or triple engines, the constituency that wants the airport constructed and delivered on time evidently does not care so much about how a good number of the people using it to get there or out of there will actually do so. Meanwhile, let's hope air traffic continues to grow at the same rate or faster. 161 million domestic passengers flew last year, which was up 6%. If not, there will be other bigger problems to think about than just the lack of roads to an airport. And that brings us to the top stories and themes of the day. The Trump effect continues as markets are now in a free fall. How do you really pick a mutual fund? The rupee has a solid rebound thanks to the Reserve Bank of India's intervention. And the Indian pharmaceutical industry braces for tariff hits. And the city of Hyderabad and the state of Telangana make peace with the beer makers.
This is a core report with Govindraj Ethiraj.
Consistent selling by foreign portfolio investors, slowing economic growth, concerns over weak earnings, and of course, a weak currency continue to hit market sentiment. And then there are the Trump tariffs, almost like a slow-moving avalanche. Indian stocks have lost about $180 billion in market value in the 2 days since President Donald Trump said he would slap reciprocal tariffs on several countries, with many analysts saying the world's fifth largest economy could be the worst hit, according to a report in Reuters, and more on that worst hit shortly. The Sensex has fallen nearly 2,300 points in the last 5 days, and the Nifty 50 has fallen below 23,000. On Tuesday, the Sensex fell about 1,018 points to close at 76,293, and the Nifty 50 ended down 309 points to close at 23,071. Broader markets were also very weak, and we'll touch upon that shortly as well, as the Nifty Small Cap 100 and the Nifty Mid Cap 100 were down 3.5% and about 3% respectively. A report in Business Standard says that in the past 2 months, the small cap index on the NSE has fallen about 17% from its record high of 57,827, touched as recently as December 12th, 2024. The index is on the cusp of hitting a bear phase, termed as a fall of 20% or more from a recent peak. Shares of small cap companies have been under pressure thanks to various reasons, including, of course, slowing corporate earnings. And meanwhile, the rupee did a strong rebound thanks to strong interventions by the Reserve Bank of India. The rupee closed 0.7% higher at 86 rupees 82 paise against the US dollar, logging its biggest one-day gain since March 2023, according to Reuters, which also said that Reserve Bank likely sold between $4 to $7 billion to shore up the currency on Monday and help keep it above the 88 rupee mark, even as that intervention continued on Tuesday, according to traders Reuters spoke to. The rupee had hit an all-time low of 87 rupees 95 paise, a whisker short of 88 in the previous session. So, a strong Reserve Bank intervention obviously suggests the rupee has not been let go in a real sense as yet, though there have been indications that a gradual freeing could happen. It's equally likely that the Reserve Bank of India did not expect this level of sustained pressure, including foreign portfolio investment outflows, now over $10 billion in 2025 already. India, Thailand at most risk of Trump tariffs. Economists at many banks, from Morgan Stanley to Nomura Holdings, have said that India and Thailand are amongst the countries which are most exposed to risk from President Donald Trump's threats to impose reciprocal tariffs on trading partners, according to a report in Bloomberg. India and Thailand stick out because the tariffs they impose on the US are on average far above the rate charged on them by the US, according to estimates. Nomura analysts said that emerging Asian economies have higher relative tariff rates on the US exports and are thus at risk of higher reciprocal tariffs, and they also expect Asian economies to step up their negotiations with Trump. India's top importers of liquefied natural gas, including the oil and gas companies, are already negotiating purchases of more fuel from the United States ahead of a meeting between the Prime Minister of India and the President of the United States tomorrow. Thailand is considering buying more American products, adding to its increased imports of ethane and agricultural goods planned for this year, according to Bloomberg, which also adds that the average rate that India charges US imports is more than 10 percentage points higher than US tariffs on Indian goods. India and Thailand are amongst the Asian economies that may face a tariff hike of up to 4 to 6 percentage points, assuming the US imposes duties to reduce the differentials, according to analysts at Morgan Stanley, who added that there may be scope for India to boost its purchases of US defense equipment, energy, and aircraft. The other interesting aspect of Indian exports is obviously pharmaceuticals, and that is something which is a large number, and we'll come to that shortly. SIPs in small cap mutual funds. Small cap funds pulled in some 35,000 crore rupees in calendar 24, nearly twice as much as what large cap funds have received, according to a report in Business Standard. Now, the phenomenon is not surprising given that small caps in general have remarkable resilience and appreciation despite all kinds of doomsday scenarios painted by the veterans and some intervention by the regulatory body, Securities and Exchange Board of India, last year. Now, all of this is obviously till now. A controversy got kicked off last week after the chief investment officer of ICICI Prudential Mutual Fund advised caution regarding systematic investment plans or SIP investments in mid-cap and small-cap stocks. And he said it's a clear time to take out lock, stock and barrel from small and mid-caps. And this is something that we at Core also reported and discussed yesterday with G. Chokalingam. So the perhaps larger question is, how should one regard mutual fund investing in general and specific, and what should inform that approach, and what does some of the history tell us? I reached out to Dhirendra Kumar, veteran mutual fund industry tracker and founder of valueresearchonline.com, and I began by asking him to tell us how he was seeing this recent controversy.
No, it will not only survive, it will thrive. And let me tell you that, people are actually missing out on the context. Small cap, mid cap, and, large cap, multi cap, flexi cap, or, there are mainstream vehicles, there are diversified vehicles. The mutual funds were invented to make, investing simple. And with that in mind, earlier, most mutual fund used to be a go anywhere fund. And that is what you can actually call the tax saving funds as one. They are not restricted by their mandate to invest in small cap, mid cap, or any sector or thematic theme or anything. Likewise, this is something investors' favorite pastime is to chase recent performance. And they are, particularly susceptible simply because, small cap funds invest in smaller companies. Some people chase a defined supply. If you have to rig a stock, you really can't rig, you can't really go and rig TCS or Reliance Industry. But you can surely do something about a 300 crore capitalization company where you will have 150 crore with the promoters and another 40, 50 crore with some set of investors who will not sell. So the float in the market will be less. So that is why, when a defined amount of money goes about chasing, and we have seen that recent past performance, it becomes a self-fulfilling, a circular thing. More money pouring into small cap fund, they in turn, mutual fund managers are slaves of investors' money coming into which fund. If they get money in liquid fund, they will invest in T-bills. If they get money in small cap fund, they will invest in small caps. If they get money in index fund, they'll invest in index, nothing more, nothing less. They are expected to be fully invested. Small cap becomes more vulnerable simply because, they're more volatile. And if more investors if they start pulling out, they're so much more vulnerable. They can actually fall much more freely than the overall market. And that is what we witnessed in 2008 as well. When the market fell, the small cap funds actually fell by 70-80%, while the large cap, the Sensex, fell by about 45%.
Right. So what we are seeing today, however, is of course an unprecedented flow into the small and mid cap. I mean, last year, the figure that I have, you can correct me if this is not correct, is about 35,000 crore went into small cap funds and SIPs, and that was half of, and this was double of what went into large caps. So this obviously means that appetite is going in a certain direction from the investor's point of view, but the stock is just not there, or not enough, at least at this value or a affordable value. So there is a mismatch there. So how does this correct? Is time the only factor, or?
Time is one thing. The other is, we will have smaller companies evolving from the. Now, the problem is that, the small companies tend to be generally in a market like this. If a promoter gets excited about going public today, he is normally of the racketeering kind. He may not need the money, but simply because, he'll go public simply because he's getting the money easily. And that is what we have witnessed in all the SME IPOs. And that is where all the investigations are on. That is where, and for a while it can be sustained. The stock price can be rigged to a poor level that, some investors can be eased out or they can get an exit. But I think the only way it can happen is, once we have many of these smaller companies which were venture funded, they start going public. I'm referring to small caps which are sub 10,000 crore. We have witnessed, some very high quality small caps coming into being. You have many of these new generation companies also, and some of them are profit making too. There will be a supply, but there is Bombay Stock Exchange listed universe is so big and so old that you still have every 5-7 years, you have something like this happens. Then lot of old companies come and weave a story and start dodging investors and actually start taking money.
So you're saying that basically, while investors should obviously continue to invest, I mean, this is sort of the last piece of advice I could ask you for, is that should you be maybe looking at the slicing differently? So earlier the slicing was, or not earlier, but let's say in the last couple of years, it may have been small cap versus mid cap versus large cap. And maybe occasionally some sectors, invest in defense companies or emerging opportunities and things like that. So if you look at where we are today in the beginning of 25, with the markets clearly in a weakened state, what do you feel investors should define their investing strategy in mutual funds, including via the SIP route?
I think for investors, they get attracted to these small caps, mid caps, thematic stories, or a sectoral play. But investors have a very simple, clear roadmap. They should do SIP, and they should do SIP in a diversified vehicle. And I'll just list the diversified vehicle for you. The tax saving fund, even if you don't have to save taxes, they are worthwhile because, it is filled with individual investors. They are not very big. And flexi cap fund, multi cap fund, the value fund, and aggressive diversified hybrid funds, aggressive ones, which is 75% into equity. A 75% equity, 25% into debt. Most investors' need can be very nicely filled with this one. And you don't need a sixth fund. This is your investment universe. And what happens is this variety of investment that we have, small cap, mid cap, and all the thematic and all the sector funds, they are basically to tempt investor because investors look at recent performance, something or the other is always at the top or at the bottom. The ones which are at the top, they are also at the bottom. They dominate the bottom at the top. So just ignore them and make sure that you are investing for 5 years and more. If you have done this, then you don't have to listen to Naren.
Okay. Dhirendra, thank you so much for joining me.
Thank you.
Will India's pharma exports be hit? India's pharmaceutical exports are projected to double from something like $27 billion last year to reach about $65 billion by 2030 and beyond. Now, of the current figure, that's about $27, $28 billion, roughly 31% or less than a third goes to the United States, making the US the top importer of Indian pharmaceuticals. Not surprisingly, it is or likely to be in the crosshairs of the Trump administration, given that India is a net exporter. A Bain & Company report said recently that India currently ranks 11th in pharmaceutical export values and could obviously grow this substantially. The largest component of India's pharma exports at $19 billion, or 70% of total exports, are generic formulations, which are expected to grow to about $190 billion by 2047. Now, I reached out to Dr. Viranchi Shah, spokesperson and until recently president of the Indian Drug Manufacturers Association. He's also a member of Pharmexil, the Pharmaceuticals Export Promotion Council of India. And I began by asking him how the industry was gearing up for the new Trump wars.
I believe that the industry is watching this news very cautiously. And I don't think there is one, let's say, opinion that has been made so far for several reasons. Number one, we don't know if the pharmaceutical industry will have tariffs on it or not, because pharmaceuticals are life-saving drugs, right? And they do impact the availability and accessibility of drugs in the US as well as in all the other markets. So usually governments are not very hard or very strong in terms of tariffs or barriers for such kinds of life-saving or critical imports. So we are not very sure whether India will be subjected to tariff or not. One, and second, even if there is something that does happen, whether pharmaceuticals will be a part of it or not. But a general sense is that almost 40% of the generics sold in the United States originate in India, and we play a very constructive role as far as the healthcare system of the US and several other countries are concerned. So hopefully we will not be subjected to tariffs. However, if suppose it happens, one of the impact that I see is that suppose we consider the impact on the APIs, because APIs is something where India and certain other countries like China and other players do play a part. In such cases, it will then have to be seen what is the difference between the tariffs on India versus the other significant players in the same product. And most likely, even in such event, if the tariffs on India are lower than tariffs on some other countries, even in that case, in my personal opinion, we are here to gain, because the other source of API would be that much more affected as compared to an API coming from India. So that would be in a favor in a way, hypothetically, if this is what happens.
So, a couple of questions. So, first is like President Trump has been referring to in the case of, let's say, industries like automotive, where they want to go after steel and aluminum, where there is scope for domestic manufacturing, or at least the feeling is that they can substitute with domestic manufacturing. Is there domestic manufacturing capacity or the possibility of it in the US for these kind of categories of drugs, including generics?
Very limited. But just to give you a comparison of one of the companies I know, and the cost of converting 1,000 tablets, for example, from an API to a tablet, doing it in the same company's plant in India was approximately about $4.50. And doing the same product with the same ingredient, same equipment in the US was in excess of $30. That was a comparison I know about a company which is based on a dependable data. So, kind of cost escalations that go, then only for very high value products, it may get, let's say, more competitive to do it, or at least not raise any issues when you transfer that product from India or any other country to the US.
Okay, let me put it differently. I know we are sitting here in India, but how price sensitive is the market? So let's say we are exporting $27 billion worth of products. Assuming there are, let's say, 10% tariffs, the value of that becomes, let's say, $30 billion landed on a very rough basis in the US. What is the price sensitiveness of the US consumer to this category, in your understanding?
Let us understand it. The price competitiveness, the US is a very different dynamics. There are certain major players as far as distribution is concerned, or 3 or 4 players really major in terms of their reach and size. And then there are a set of importers and pharmacy benefit managers, and it's slightly different from what we have in India. So that simple comparison cannot, but I can tell you as far as the importers are concerned, how does that translate into a retail price is a very different game. It depends on several factors. But as far as the imports are concerned, definitely they are price sensitive. We have to compare of what could be the cost of doing the same in the US. Or is there any other alternative supplier that can be more efficient, more cheaper, faster than India? So, at least in the immediate or short run, I don't see any other player which has the kind of capabilities that India can offer.
And US is roughly 30% of the market of all pharmaceutical exports from India, or one third. What are the opportunities like in the rest of the world? How is that looking to the industry right now?
So, if you see consistently, for example, I think the last year's growth in export was in excess of 9% as far as pharmaceuticals was concerned. And we have a similar trend if you compare. See, COVID was like 21, 22 was a different because everywhere there was a supply chain and there were unrealistic growths and changes. But if you see for the last 5 or 10 years, apart from removing that COVID period, our exports has consistently grown. Our last couple of years, it has been in excess of 8-9%. Currently, when the growth in exports is facing certain challenges in terms of overall numbers for the country, pharmaceutical still continues to perform well. So I believe that there is therefore a very positive outlook for the international demand for pharmaceuticals from India.
Right. And are there any other trends that you're seeing? Last question as well. Any other trends that you're seeing in 2025 or this year, apart from, let's say, the where all the attention is going to be, which is exposed to the US?
See, US is actually a trendsetter, right? So we must understand that if US is tariffs, so US does certain things not only in pharma for any other commodity, there will be countries who will try to emulate. Now, everybody will not be able to do because the kind of size and scale of US and the importance it carries in global trade is so much higher. So, for example, another country in the Africa, if they want to do something that US does, while there could be a political wish probably, but in terms of actual execution, they may not be able to do. But definitely, there will be local noises that will come forward and say, why don't we also add 10% in import duty or do this or do that? So those kind of challenges will continue, in my opinion, in 2025. But how much it actually translates into an impact on business, especially in pharmaceuticals, I'm not too sure.
Right. Dr. Shah, thank you so much for joining me.
Thank you. Thank you.
The beer wars end. India's top beer consumer state, Telangana, has allowed beer prices to be increased from Tuesday, weeks after a brief halt in supply by Heineken's Indian unit United Breweries over pricing issues, according to Reuters. We're only returning to this because we reported the original battle, which is an interesting case of doing business with a state in a highly regulated environment or market like alcohol. The order also directed that all existing stock be sold at the revised rates from Tuesday. In January, the Kingfisher beer manufacturer halted the supply of beer to the state and said that it was doing so over delayed payments and a lack of government approval for higher prices since 2019-20, which was hurting its finances. United Breweries dominates the market in the southern state of Telangana with a 70% share, and it's obviously a listed company. India is the world's 8th biggest alcohol market by volume. And states, as we discussed a few weeks ago, individually regulate the pricing of alcohol products, and each state does it quite differently and uniquely. Musk makes a bid for OpenAI. Elon Musk aims to slow down a competitor when the investor group he led put forth a $97 billion proposal for control of OpenAI, the company's CEO Sam Altman told CNBC on Tuesday. Asked how seriously he's taking Musk's bid, which Altman previously declined in a social media post, the OpenAI chief said not particularly. He said he thinks it's to slow down a competitor and catch up with this thing, but I don't really know to the degree anybody does. In response to reporter questions on the sidelines of the AI Action Summit in Paris, something that Indian Prime Minister Narendra Modi is also attending. The $97 billion bid is for the non-profit that oversees the AI startup behind ChatGPT. Elon Musk has his own AI company called XAI, which is behind the chatbot Grok. That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.